Okay, so welcome to part 3 of our series where we're diving into mastering your option strategy. And today we're going to focus on one of my favorite subjects, which is technical analysis. And so we'll go into a deep dive on really understanding technical analysis. If you attended the Greek section, we're actually going to tie that in as well. But I'm also give you a quick reminder of what happened with the Greeks, just in case you weren't unable to attend that session. That way you have everything you need along the way. And we do, of course, encourage you to attend those next sessions. And if you didn't see previous ones, those recordings will also be sent out. And of course, before we get started, I do have to make sure that I just give you a quick disclaimer and know that I am going to pull up securities. They're purely for demonstration purposes only. It's not considered a recommendation by Options Play. We have a due diligence process that is provided by our screens and when we offer daily plays and things of that nature. So when we pull securities, it's purely just for example and information purposes only, doesn't constitute taxable or investing planning advice. So nonetheless, let's go ahead and look at our agenda for the day. Went a little fast there. So we're going to look at the value of technical analysis. What is it used for? What are the principles associated with technical analysis? And then we'll look at option strategies that we can apply to that. And they tend to go hand in hand. It's very interesting. If you are interested in options, then you'll start trading and utilizing technical analysis. And then the inverse is also true. If you really are utilizing technical analysis and perhaps it's only for stock or equity trading, you tend to graduate into options trading. And my theory is that most people who are really like options are very analytical and data heavy, and both of those have similarities in that regard. We'll look at price analysis and patterns. We'll also look at some chart overlays. So I'll give you some examples of indicators, how to utilize them and apply them with options or not. And of course, different types of indicators, and we'll save some time for Q&A. All right, so you might have seen this slide before, but what I want you to remind you of is this is an options course, and there are two types of buckets, if you will, that options trading falls under. First and foremost is seeking income or gaining directionally. So if you're seeking income, those are normally your covered calls, your cash covered puts, and credit spreads. We'll focus on credit spreads today. Your goal when you're seeking income, and that is the strategies that you're implementing, is you are directional. You have a directional bias, but you're also neutral. So you expect some movement, but little. So that's the important part that I want you to keep in your mind as we go through this presentation. And then your ideal outcome of those option strategies is for each contract to actually not have any value in decay as it gets closer to expiration. And that is true because the option, it just needs to be out of the money. And that can happen if it's just one increment below or above the strike price, below if a call, above if a put. So that's what makes it neutral and have that small directional bias. Now, gating directionally, it's a little different. That's where we're going to have our long calls and our long puts, and that will turn into debit spreads as well. Debit spreads are just an extension of your long calls and your long puts. You are very directional with these trades. You expect a sharp movement of the underlying, and you have conviction of that sharp movement. And your goal for those contracts is to increase in value as much as possible. But what we're going to focus on today, aside from the strategies that align to it, is sentiment. So what's really important when you're trading options is not only do you need to understand the sentiment of where you feel the overall market's going to go and that security, but that needs to align with the strategy. So these strategies align to just small directional bias, really neutral, whereas long calls, long puts, and debit spreads are sharp directional movements. So that definitely needs to make sense. So if that makes sense to you, go ahead and type a 1 in the chat for me. Do a quick little knowledge check there. Lots of 1s. Perfect. Thank you. All right, we shall move on. Now I'm going to give you a quick review of what we looked at last time. And we went into my other favorite subject, which is the Greeks. Now, this is a really helpful tool if you didn't attend that session, but in general, as far as really looking at what's driving your strategy and the forces behind it. And the reason I want to bring this up, it just really reiterates what we just spoke about. Long calls and long puts, these are largely directional. So they profit from a sharp movement or sharp downward movement. And let me predecess this with bullish strategies are found at the top and bearish strategies are found at the bottom. Anything that is purchased, we need a sharp movement. And that's because we've purchased time, and therefore that time decay component is negative. So that's the reasoning behind that sharp movement. And the way that we can see that is with a positive gamma. We'll associate that. And then with short puts and short calls, we can see we still have a directional bias. However, we have theta on our side, so that time value that depletes, but we have a negative gamma. And what that means is a sharp movement in the underlying actually equates to risk. And that's what's the important takeaway is here. A sharp movement in the underlying is good for options that we've purchased. It equates to risk for options that we sold. So therefore, gamma is positive for the long options and negative for short options, regardless if it is a call or a put. Simply just looks at being purchased versus being sold. And of course, the vega values here. All right, so let's look at moving on to technical analysis. Now, I don't expect you to know all of the Greeks or keep those in mind, but that's why we built that chart, is you can literally print that out, keep it, and it gives you a good indication of what's there. So the value of technical analysis. So why do we study technical analysis? So first of all, by definition, it's the study of market data. You're looking for patterns and events. And there's mathematical studies associated with it, statistics, standard deviations, means, medians. All of that is utilized through indicators, and that's where we assess investment behavior. So you identify areas of supply and demand, which translates to areas of support and resistance. And I'll give you some really good clarification of that once we look at some visual examples. But the whole purpose of assessing that investment behavior is to analyze future price movement. So we're trying to understand, is this a bullish or bearish opportunity? At what price may this perhaps stop? Things of that nature. So you're looking to decipher the potential direction of that security. Is it breaking out? Does it normally break out above this level? Does it have a hard time to break out above this level? And so it's all really supply and demand. If there are a lot more buyers than there are sellers, so higher demand, less supply, that's going to cause the market to go up. Then the inverse is also true. If we have a lot of sellers, so more supply coming into the marketplace, then less buyers, so little demand, then that's going to cause the market to go down, or that subsequent security to go down. So all of it, fundamental even, it's all components of supply and demand, especially technical analysis. So before you dive in and learn technical analysis, there are three basic assumptions that we just utilize from foundational terms. And all of this, the first technical analysis actually derived from something called the Dow theory from Mr. Charles Dow back in, I believe it was the 1930s. Don't quote me on that one. But nonetheless, it's just the study of patterns and events. So assumption number one is the markets are forward looking, meaning the markets discount everything as news comes out. It prices in new information. So as new information comes in, it brings it to light. So great example, as we have earnings come in, and if you miss or beat analyst expectations, the market reacts automatically. Or if the Fed is going to raise interest rates, the market reacts automatically because it's constantly trying to anticipate, really to that next earnings cycle, what's the actual value of all of these securities that make up the major indices. So it's a forward-looking component that's trying to understand actual valuation or price, fair price of the underlying securities that make up the overall market, or what we're looking at. So that's assumption number one. Assumption number two is prices tend to move in trends, and they are observable and they remain until otherwise suggested. So if we see something that's in a clear upwards trend, an upwards trend is defined as higher lows and higher highs, we're going to assume that we're in an upwards trend until we have significant evidence that that has stopped, which would be very simple. If an upwards trend simply means higher lows, if we fail to make a higher low, then that is a clear indication, or at least first signal, that this trend might be over. So there are signals that we utilize in technical analysis that we verify with other indicators. And again, we're going to go into that as well. And then the third assumption is history often repeats itself. So patterns and signals, we expect repetition. And that is based on attributes of human nature, like fear and greed, or why we're looking for things like capitulation when trying to understand a market bottom. So really great examples that I'll give you of that once we actually physically look at a chart. But the basic assumptions, keep these in mind, and this is what the foundation of technical analysis is really built upon. So let's look at option strategies for technical analysis. Let's put some things together, and then we'll dive into the indicators. So the good part comes next. So first and foremost is, if we expect a sharp movement, I would expect you already to say, okay, I'm going to go long. So buying calls and puts or buying a debit spread. So that's a sharp movement. If we expect little to no movement or have a small directional bias, then that's when we'll sell credit spreads. Now, we are saying credit spreads and not short calls and short puts due to the risk reward profile, and that's a completely different strategy, and we can talk about that as well. So that's just direction. Now, what we haven't talked about yet really is magnitude, and that's where we're going to use technical analysis to understand our direction that the security is going to go. Magnitude is going to give us our stopping point. So if we have a clear resistance zone where we have we see that a security is at perhaps 100 and we feel it's going to stop at 115, then that is clear, right? But if we have an unclear movement, then there are different strategies associated with that. So if I expect a sharp movement and I have a clear resistance zone, and I'm sorry, these are actually flipped here. This should be the inverse. If we have an unclear resistance zone, meaning I don't know the upwards potential, then that's when I would buy a long call because I'm unsure how high it will go. That has a good risk to reward profile. That's what we need to associate it with, because we don't know a clear stopping point. Therefore, we are going to position ourselves with risk reward in our favor, meaning we are going to spend less than what we could potentially make. And that's an important component of options trading. However, you have a lower probability of profit because you need to overcome the amount that you've purchased, which is that magnitude or sharp movement that's required. Now, if you have expect a sharp movement, and again, I apologize, these are flipped, this in a clear resistance zone, so you know where that's going to stop, that's the purpose of a debit spread. You have a better risk to reward profile because you've reduced the amount that you've paid for the contract. You still have a lower probability of profit, but that's because risk versus reward is skewed in your favor. That's inherently true when purchasing options. But what you do here clearly is, okay, if we're buying ABC, have the right to buy ABC at 100, we paid 5 for that. You're setting a stopping point. That's what a debit spread is you say, okay, I'm going to give up any gains if the underlying security moves past 115. So we're going to give up our gains if we feel that it's very likely that it will not move past that point. So that's why we say clear resistance zone in that case. And then, of course, if we expect little to no movement, we're unsure of a resistance zone, maybe a support zone, that's where we'll sell credit spreads. Now, your risk to reward tends to be less in your favor because you're going to be risking more than you're going to potentially make. That's true whenever you're selling options. However, probability of profit is skewed in your favor, and that's because you don't need a sharp movement. So it's important to, before we assess direction of a security, we have to know what option strategy is optimal for that environment that we're defining. So if that makes sense, I would love for you to type a 2 in the chat. And again, that is a 2 in the chat if that makes sense. Thank you. Great. All right. So let's look at support and resistance. So support and resistance, remember, this is supply and demand. That's all it is. Buyers versus sellers. So this is something that's in a period of consolidation. And we can clearly see almost like a ball bouncing from floor to ceiling. As it moves up, clearly fails to make a higher high, moves down, this perhaps could be a zone, moves up again to that old high, fails again to make a higher high, moves down to the same level, and you can see at this the pattern continues. Strength in the pattern, or multiple tests of a resistance point or a support line, strengthens that area of support and resistance. So here we would assume that this is an area of demand. There are a lot of buyers. When it hits this place, buyers are coming into the market until it hits an area of supply. Now, there is a psychological aspect that goes into this. So imagine that you purchase this security up here, perhaps in this 50 area. This comes down, and this is a clear line of 50. And you might be expecting it to break out. If we were to broaden out this chart, we'd see it coming down a lot more. If there are a lot of people who purchased a security here, and this is how things flip, because this was an old support zone, meaning it held at this level, you may have people who own a lot of securities here, in which case this is their break-even point. So when it reaches this level, they decide they don't want to take any more losses, so they sell it. So that's how your area of supply and demand really come into play. It's people feel that this is an okay place to purchase. That's an area of demand. Therefore, it becomes support. This is where investors or traders feel that this is an optimal selling point. Therefore, this is an area of resistance and an area of supply. So more shares, buyers versus sellers, that's all it is. So lots of supply and demand. So how do we use that to place trades? Well, this is a clear, strong indication of a pattern that I have on the screen here. If we see a bounce off the support and resistance, and we have a clear target price, and that's what this is. We have a clear target price to here, a clear target price here, a clear target price here, a clear target price here. And if we're here, I'd have a clear target price here, right? That makes sense because it keeps from floor to ceiling, and that's what I'm looking for. If combining other indicators, this is where it's really important. We're just showing one component. There are other indicators that we want to match this with. You can never rely on one indicator or one system. You find 2 are really the sweet spots, 3, but you need some, and you look for harmony. You look for clear indications that this is either a bearish signal because it's moving down, and we'll go through that. But just know that don't rely on this all the way. But let's assume we've done our due diligence, and I'll take you through that process as well. And we are expecting this security to go down. So now that we're at our resistance point, this could be a clear direction that perhaps we should purchase a put or a bear put spread. And we could sell the option at this lower price, maybe buy here something at the money, but that's how we add and layer option strategies into technical analysis. Timing the market is incredibly difficult. Not many people are good at it, and that's okay. But what we can do is understand technology has really progressed, and we have a lot of tools and resources at our fingertips, one of which is technical analysis, which can help us give us indication of patterns and events and perhaps good entry and exit points. And that's what we're looking for to define when we layer on options. And part of that is also looking at different time frames. And I can show you on Options Play how we do that for you. But for example, a shorter time frame, like an hourly chart, is not as much strength as a daily chart. And then a weekly chart even has more strength because it's more time. That's logical, right? The more time that is across the chart that we're looking at, the more strength that movement certainly has. So that's what I want you to be cognizant of when we're selecting time frames. We want to look for multiple time frames to agree. So daily, weekly, monthly, you have those agreeing. Now we've got a clearer picture of market movement overall, and of course with the underlying security that we're analyzing. Now, if we feel that perhaps there's a bounce, we're unsure of magnitude, and I would perhaps flag this right here, and that's because from here to here, I see this other piece of support forming. Carter Worth says something, and I'd love to give him the credit for this analogy. Support and resistance is like a mattress, and that's so true. It's not necessarily a straight line, it's a zone, which means do you sink into the mattress and fall all the way through, or do you sink in and you bounce up and then flip that around if you're on the top part? And I think that's just a wonderful analogy because you can see other areas of support and resistance forming even on your larger areas. And so just failures to meet a higher high or failures to meet a lower low is what plots these. These are manually drawn support and resistances on the options play tool. We actually draw them for you as well and describe them. So we even take that work out. But no, there's also indicators that can do it for you. But if you have an unclear indication of direction and you see perhaps this area of consolidation here and here, and you feel that there may be a bounce up because that's a pretty big run right here, then perhaps you're unclear of the direction. So therefore you want to sell a credit spread at that point. So those are the rules that are important. I'm have an indication of direction, unsure of magnitude. That equates to, am I buying or am I selling? What risk reward profile am I willing to accept at this moment? And that's really what options trading is about. Risk versus reward profiles. We couple that with technical analysis, which is in the most simplest terms, supply and demand. So as far as clear support and resistance, I would love for you to type a 3 in the chat if that makes sense as far as areas of supply and demand. Thank you. Great. All right, so let's look at breakouts and breakdowns. So this is where we have a breakout without a clear target price. So here we have a failure, or excuse me, we did make a higher high. We had a failure to make the higher high here, but we broke out above that. So now if we don't have another high to compare this to, theoretically, the security at this point can go to any price. I personally love to add Fibonacci extensions just to get an idea of that. But there is a lot of upward potential at that moment. But no, what happens in these scenarios, my mouse is very sensitive. This was resistance. This flips old resistance, now becomes new supports. And if we were to look across this chart, we would see if it did not continue to just rapidly increase, what it did do was keep this line supported, meaning when this line occurred, more buyers entered the market. There was an area of demand causing the security to go up. So that's really important with support and resistances is they take turns being each other. And that's a very good, clear distinction of when we have a breakout. When we have a breakout above a resistance line, that old resistance becomes new support. Is it still supported? Do we have unclear magnitude? So therefore, this is an opportunity for long calls or selling credit spreads because we're unsure of when that stopping point's going to be. Selling a credit spread, for example, if we have a break up above this, we'd want to sell a put because it means if the underlying security remains just above the strike price, that's going to cause it to the put not to have any value, which is the goal, if you remember from earlier on, because a put contains the right to sell. And if the market is pricing at a better price, so higher than our strike price, that put doesn't have any value because you can sell the shares on the market. So that'd be an opportunity if you were bullish there. Or if you felt that there was a lot of magnitude, then you'd purchase a call, in which case we need a sharp directional movement, be profitable. And then if you feel like this chart was completely flipped, you just do the inverse. A breakdown, you have perhaps some clear direction and clear magnitude, then we'll do a long put and a debit spread, clear magnitude, debit spread. That's what's important to equate to there. But what's important from a technical analysis perspective, and the key takeaway here is old resistance becomes new support. And then from there, we analyze our directional move and the magnitude of that move. Does it have a stopping point? So if that makes sense for you, go ahead and type a 4 in the chat, and then we shall move on. Great. All right. And before we go past the trends there, and know that these are drawn lines, you can draw these lines also as an upwards trend. So this is clearly a place of resistance, but you could also just manually draw a line here, and I'd see a clear uptrend of this is a lower high, right? And a higher high. So that's indication of an uptrend as well. So those are items that I would search for. And you can do the same on the downside. So technical analysis can be drawn, or you can utilize indicators to do it yourself. It's entirely your method. And perhaps that's the beauty of it, is they're all found under the same foundational elements. And as long as you come back to those foundational elements and then apply your method, you've really created something that's certainly very helpful. So chart patterns, reversals, and continuations. So these are just those technical patterns that head and shoulders, cup and handles, flags and pennants. Those are considered potential reversals or continuation of the trend. So oftentimes you'll hear someone say, oh, okay, there is a clear head and shoulders, so therefore I think there's going to be magnitude to the downside because of this commonly accepted continuation or reversal pattern. So I want to make sure that we at least cover those as well, and you could utilize those just like we did with support and resistance. All right, so let's look at lagging indicators. And we're going to start with moving averages, and then we'll add a Bollinger Band. So a moving average, just a simple moving average, is your normal average calculation. This default is a 20-day. You can also have many days of moving averages, so you change your period. But the most common ones, I would say, are 20-day, 50-day, 200, and then of course you can expand that to weekly, so 20 weekly, 50 weekly, and 200 weekly. Again, the longer the time frame tends to be the strength or stronger the resistance or support. And just like we manually drew our resistance and support, moving averages act exactly the same. And moving averages, we call this a lagging indicator because it takes into account everything within that period and then divides it by the amount of that period and applies the average, so that normal average. And if you've studied mathematics, if you have something a little high in there, that can sometimes skew things. So therefore, there's other items that we would look at. But I want to show you what it means from an area of support and resistance. So this is the 20-day moving average. This security, this acted as support as a movement, but as we broke down below it, now old support becomes new resistance. And we are technically in a bearish trend as we're there. Looking at the broader S&P 500, I'm watching the 200 daily average. We haven't been above that since January. So that's what makes it such a very strong resistance point. And that's why it can be very helpful to apply with your technical analysis. And then of course, entry points when we're defining which strategy to apply in regard to technical analysis. So this is a clear failure to go above that resistance zone. Here, we did make it above, and you notice how when it does, gets a period of consolidation. That is something that comes from the Dow theory. The Dow theory states that there is a period of consolidation prior to a trend reversal. So as this moves above, now resistance becomes support once more. And then as we move across the chart, we see that there's a little bit of support here. It failed, went above, failed once more, and now support becomes resistance, and then resistance becomes support once more. So what you can see though is these are really great indications of when something might perhaps reverse from bullish or bearish. So those moving average crossovers, they give us a clear direction, but they don't give us that magnitude. So that's what we need to apply. What we've been talking about up until this moment is directional movement, but know that this is a lagging indicator, not a leading indicator. So we want to make sure we pair these with multiple items, and we'll go through that in some detail as well. But you can apply this on your charting tool. You can on options play, just simply a moving average that acts as support and resistance. So let's add on Bollinger Bands. So Bollinger Bands actually utilized standard deviations. So it's giving us an indication of the normal deviation within that period, which then acts as an area of magnitude. So this is that same chart, but gives us a stopping point. Bollinger Bands, if you have never used technical analysis before, this was actually the first one that I learned. I don't even know how long ago, a long time ago, the early 2000s. But what it gives us is that magnitude. So now, by adding that extra layer to our moving average, we've given a clear stopping point, if you will. Now, this is something that's lagging, and again, I would not use this individually. However, if I was looking to utilize a debit spread or cap my profit potential, that's where the Bollinger Bands are helpful. So if I see that this crossed over, perhaps I want to buy a call here, I can put my sell point here. Now, something that's also interesting with Bollinger Bands, keep in mind that it's considered a standard deviation. So that standard movement of that security on either end. The strategy or the underlying security, it tends to move when that tightens, and there's volatility when it widens. And that's perfectly logical. You have an area of consolidation, so movement. So we're finding a smoother, a solid line within our moving average. Our standard deviation is going to be minimal because it's not moving as much. And if we go back to the Dow theory, which says a period of consolidation occurs with a trend reversal, you can also spot that with this. Right here is a great example, Bollinger Bands just getting tighter. As they widen, that indicates volatility because you have price disparity. And that is also an indication of a downward movement. And then we look for it to tighten again, which it is here, indication of an upward movement. So trend reversals, you also look for the standard deviations to tighten or widen. That's another way that you can utilize Bollinger Bands. And again, you don't have to know the math behind it. All you really need to know is if it crosses this line, it's going to hit that one, then this one, it's going to test that one, then this one. But I know it's in a clear downwards direction here because of that widening of the Bollinger Bands, and I would look for that to switch. And we can layer that with other technical analysis that are leading indicators to give us an indication of momentum. But that's Bollinger Bands in a nutshell. If that makes sense, I'd love for you to put a 5 in the chat. That's a 5. Thank you. And thank you for the compliment. I appreciate that. All right, so let's look at leading indicators. So on the screen, we have RSI. You can use MACD or stochastics as well. There are so many uses for this. I personally prefer MACD, but you can, again, use these others. They signal reversals, but they don't give us magnitude. So for example, if I'm looking for something to move to the upside or move downwards, you can also track this for divergence as well. And so it's going to give us an indication that something's going to move. Why? MACD uses an EMA, an exponential moving average, and an exponential moving average, instead of like a simple moving average where it has equal weight across all the prices, there is more weight on the prices that just happened. So that means it's a leading indicator because it's giving us, oh, new price movements coming in. Therefore, the moving average is going to adjust based on new price movement, not evenly spread across the whole time frame. I hope that made sense for you, as in the why. You don't have to know the why. Sometimes I just go into the math. But this gives us an indication of momentum and trend reversals, in addition to if something is overbought or oversold. So if someone says, oh, this market looks so oversold, that tends to happen in these extreme levels. And if it's overbought, the inverse is also true. So it's those extreme levels that are overbought or oversold, in which case we're going to look for perhaps buying opportunities. So that's an indication of reversal. What I'd like to use these for is the rule of these securities are if the underlying position is making a lower low, then MACD and RSI have to do the same. And if they are not, they're doing the inverse. So for example, the S&P 500 or whatever security keeps going down and down and down, but MACD or RSI is making higher highs, that's considered bullish divergence because the security is going down. But if you take into account these more recent price movements, then there's an indication of something moving up. And we can bring up options play, and I'll show you this is not a clear indication of that in the slightest. But these will tell us indicators of perhaps potential movement. So when we see it crosses above this line, we expect the security to go down, and then the oscillator moves with that. Crosses above this line, we'd expect some movement up, but now we've found a period of consolidation, and that period of consolidation also matches the price action that we see on the chart. So therefore, this is a good way to give an indication of trend reversal, because now we see at the Bollinger Band, perhaps that's its ending point, but when is it going to start again? And we're looking for extreme levels outside of these areas. Normally, this one's a 20-80. If it's moving a little bit, you can add a 30-40. You can even extend it out to a 100-0 if it's something super volatile. But this is where we have clear direction, but we don't have magnitude, and therefore credit spreads are optimal with this type of trading. All right, so that brings us to the end. So I hope that gave you some value. I'm going to bring up options play so I can show you how you can utilize technical analysis. So I'm going to stop sharing for one brief moment before I give that to you. We do have a link on the screen. And while I'm pulling that up, if you have any questions, please feel free to type them into the chat window or the Q&A window, and I'm happy to answer those. Are you looking at IV rank? That is a wonderful question. So we would look for IV rank if we're trying to understand if we should buy or sell as well. So that gives us an indication if options are expensive or not. So if we see an IV rank over 50, then it is expensive relative to itself, in which case that's also a good indication that a credit spread would be optimal in this type of environment. So we want to layer that on in addition to the market movement that we expect. I entered an invalid. Great. For some reason, I cannot log onto my account, so I apologize for that. While I'm doing that, are there any other questions? Now, what I could do is bring up, and yes, we are looking to implement that. Thank you for that question. I apologize. I am locked out of my Nordic account. So I'm just going to bring up a US version just to give you an indication of the charting tools. All right. So here is our charting platform, and I'd love to show you some of the really helpful information. So I'll just pull up the S&P 500 so you can look at a broad-based index just to share some things that it's applicable to every security, right? So the support and resistance zones I was talking about, we plot those and we'll give you indication of what that is with some price action. We also plot the 1 month trend and the 6 month trend. And like I was saying, something with a shorter time frame has less strength than something with a longer time frame. So if we find that there's harmony in these, as in the 1 month trend is probably going to turn bullish first, as it did here, but then as both become bullish, then that adds strength to the trend, which occurred with this huge rally here. So that's one way where options play does the heavy lifting for you. Now, within the tool itself, you can add quite a bit of studies and indicators based on your own method. There are so many indicators, as you can see here on my screen in regard to technical analysis. I'm going to take away this one, see, and we'll add MACD just to give you an indication of what I was talking about before. So bullish divergence, that's why I think this is extremely important. So with MACD, this is looking for a couple of things, which is a crossover, gives us an indication of upwards movement. Very clear here, right? I cross downwards over the signal line, there's a downwards trend. Across upwards, there's an upwards trend. You can see it moving across, and this is on a daily time frame. You can adjust that to a weekly or a monthly. But the bullish divergence that I wanted to share with you is, as you see, this is clearly a lower low right here in October. MACD did not make a lower low, and I made a higher high. So this right here is considered bullish divergence. And as soon as we see that crossover, that indicates an extremely strong rally, which is true. Now that's your leading indicator. You then want to pair that with your lagging indicators, which is where we would add those moving averages. In addition to, again, it's completely up to you. Moving average. So here's a simple moving average. So I would have spot this before. This is an area of resistance, but you made consolidation. So those are things we watch for. But there's so many indicators that you can add. And we just went through a couple of the basics today. But I do want to encourage you to take some time to learn that. But at Options Play, our goal is to make everything as easy as possible. And that's where this 1 month trend and 6 month trend is extremely, extremely helpful. And that support and resistance that we plot. And the way that the tool is built is essentially you have your ideas here. So this is what you need to pay attention to. You verify your sentiment based on technical indications, and then you weigh your risk versus reward by utilizing this tool here. So this is giving you an indication that it's bullish. We'll pre-populate bullish. You adjust from there and compare strategies. That's where the word options play came from, is you're playing with this tool to understand risk versus reward. Do I only use MACD on the daily chart? Absolutely not. I actually prefer it on a weekly and a monthly. So here's weekly. Strength there. Monthly, I don't think this is going to pull enough data. It's not. But if you pull a monthly chart, that one I find very, very interesting. The sell signal for the MACD happened right at the peak, and it stayed that way, which I think is very interesting. Again, leading indicator, you have to utilize with additional technical analysis. Any other questions? All right. Well, I appreciate everyone joining today's session. Thank you for taking the time to learn about options and master your process and adding technical analysis, that additional layer. It's certainly one of my favorite tools, regardless if you're utilizing options or not. Just remember, there are a lot of indicators. Some show you momentum and magnitude and resistance and support. Look for something in all three of those categories to have harmony, and then you've really developed a good process. But no, at Options Play, we do our best to do the heavy lifting for you. The next session is coming up really, really soon. It's going to be November 29th, where Tony's going to go into heavy detail on learning how to trade vertical spreads. So those are spreads all together. So your debit spreads and your credit spreads. So really that's the extension, and the goal of this entire course was to make sure that you understand the great technical analysis, those underlying strategies. And now we'll go into the mastery of vertical spreads, inclusive of optimal entry points with what you've learned today, in addition to best practices when closing, utilizing everything we've learned, throughout the course. So thank you so much again for your time. Any questions, let us know. And thank you for the lovely compliments. And I hope everyone enjoys the rest of their week. Thank you.